Hello friends and welcome to StudyIQ. I am Joycey Joy and today we will be discussing about the deposit insurance in India. So we will be discussing in detail what is the current affair related to deposit insurance in India, what is deposit insurance. Basically we will discuss here what is the concept of deposit insurance and why there is a need for deposit insurance, what are the shortfalls in the deposit insurance scheme in India, and what are the reforms that are required in the deposit insurance scheme in India. So these are the topics that we will discuss today. Deposit insurance is a very important topic, and this is not only important for UPSC but also for other banking examination, and also if you are preparing for your RBI grade B examination. The RBI grade B preliminary examination is just over and most of you might be waiting for the results of RBI grade B preliminary examination. When it comes to your mains exam, that is a phase 2 of RBI grade B, this is a very important topic. Also for other banking examinations, all other examinations, this is a very important topic. You should at least know the concept of deposit insurance and what are the shortfalls. So we will be trying to discuss this in depth in this lecture. So let us begin. Let us begin with the current affair. Let us see why deposit insurance is in the news recently. So the current affair is that the RBI is the Reserve Bank of India, the central bank, the apex bank of Indian economy. So RBI, within its mandate, that is within the role and functions of RBI to regulate and supervise the banking system in India, it has recently capped withdrawals from PMC or the Punjab and Maharashtra Cooperative Bank. So this is within the scope of RBI, that is within the scope of its functions, that RBI is responsible for regulating and also supervising the banking ecosystem in the country because it is a central bank and the regulator of the banks. So within its scope, it has capped the withdrawals from the Punjab and Maharashtra Cooperative Bank. So the cap was set at rupees 1000 and we have in depth discussed about this topic before in a previous lecture in detail. So if you want to know more details of the PMC crisis, you can find the video on our channel both in English and Hindi on our channel StudyIQ. So English video I have prepared myself and Ankit Agarwal has prepared the Hindi video that is available on our channel. So you will be able to know more about the PMC crisis. So now RBI has capped the withdrawals from the PMC. So this was in news recently and this was a very important current affair. So in this context, we have to understand what is the nature of deposit insurance in India and also the working of the Deposit Insurance and Credit Guarantee Corporation, that is DICGC. DICGC is Deposit Insurance and Credit Guarantee Corporation of India. So in this context, we will be looking at deposit insurance in India in detail. So let us see first of all what was the crisis at PMC, at the Punjab and Maharashtra Cooperative Bank. Even though we have discussed this in detail in a previous lecture, I will be just briefing what happened, what was the crisis in PMC for those who have missed the previous video, just to give you an understanding what really happened in the PMC, the Punjab and the Maharashtra Cooperative Bank. So we'll just go into it. I'll just discuss briefly and then we will come to deposit insurance. So, the crisis began as the PMC, the Punjab and the Maharashtra Cooperative Bank, allegedly enabled the frauds worth rupees 6,500 by promoters of HDIL. So, what happened was that more than 70% of the PMC's bank loan exposure or the credit exposure of the Punjab and the Maharashtra Cooperative Bank has an exposure to HDIL. So HDIL is Housing Development Infrastructure Limited, and about 70% of the total loans given by the Punjab and the Maharashtra Cooperative Bank was for this HDIL. So this was not properly represented or maintained in the books of account of the Punjab and Maharashtra Cooperative Bank, and also the HDIL, the Housing Development Infrastructure Limited, its inability to repay the debt. That was yet another problem, and this could have led to a situation where the lender, that is the PMC, could have been shut down. So if in case the PMC was shut down, what would have happened? Thousands of depositors who have deposited their money in the PMC, the Punjab and Maharashtra Cooperative Bank, they would have been at risk. So this was the crisis in the PMC. Now let us come to deposit insurance and the role of the deposit insurance. So basically, deposit insurance is a measure in order to protect the bank depositors. So we have seen that when the PMC bank was under crisis, the depositors, those who have deposited their hard earned money in the bank, they would be at risk. So deposit insurance is a scheme which aims at protecting the depositors, the bank depositors. It can be partial protection or complete protection. So protection of the depositors fully or partially from any type of losses caused by the bank's inability to pay to its debtors. So for the bank, the depositor's money, it is a liability. So bank has to repay the money to the depositors. So in a situation where the bank is unable to repay the money of the depositors, then the depositors are at risk. In such a situation, the deposit insurance scheme aims at protecting the depositors from that risk. So in that regard, in that mandate, the central government has set up Deposit Insurance and Credit Guarantee Corporation, that is DICGC. The abbreviation is very, very important. DICGC is Deposit Insurance and Credit Guarantee Corporation, and this comes under the RBI. This is also very important fact. So DICGC comes under the ambit of RBI, and the role of DICGC is to protect the depositors in case the bank fails. So in case of a bank failure, the protection of the customers of the bank, that is the mandate of the DICGC. Now, the deposit insurance scheme is mandatory for banks. This is also very important. That means the banks cannot voluntarily withdraw from it, but it is mandatory. All the banks that are registered with the RBI, they have to mandatorily maintain this scheme. Now, let us come to the status of deposit insurance in India. So, if we compare India with that of BRICS countries, the BRICS grouping, compared to other BRICS nations, Brazil, Russia, India, China and South Africa. So, this is the grouping of BRICS. So, compared to other BRICS countries, India has the lowest deposit insurance cover per capita income ratio. So, we have very low deposit insurance cover, and compared to the BRICS countries, we have the lowest, the least deposit insurance cover to the PCI ratio, per capita income ratio. So this is the status of deposit insurance in India. Now coming to the shortfalls of a deposit insurance scheme in India and what reforms are required. The first shortfall is in the insurance limit itself. So the limit is the highest amount that an insurer will pay to a claim that a particular insurance policy will cover. So, what is meant by limit? Limit means the maximum amount. For example, let us take the PMC example itself. So, PMC, that is the Punjab and Maharashtra Cooperative Bank. And on one side, we have the customers, that means those who have deposited their money with PMC. And second one is the insurance or the DICGC, that is Deposit Insurance and Credit Guarantee Corporation. So DICGC's role is to protect the customers in case of bank failure. Now let us understand what is limit. Let us take this example to understand what is the meaning of limit. Now the customers are the depositors of the bank. So suppose in case of a bank failure, DICGC will pay to the customers a particular insurance amount to protect them from the risk. So limit refers to the maximum amount that the depositors or the customers can avail from the DICGC in case of a bank failure. So this is called the insurance limit. So this is the maximum amount that is receivable by the customers or the depositors in case of a bank failure. So coming to the insurance limit, the insurance limit in India is 1 lakh. That means only up to rupees 1 lakh insurance is provided. So in case of a bank failure, even if your deposit is 1 crore or 50 lakh or whatever the amount be, you will be getting only an insurance up to 1 lakh. So this 1 lakh was set in the year 1993. So this insurance limit of 1 lakh was set up in 1993 and till now it is not revised. So revision has not taken place. So this is one of the biggest shortfalls. Many people argue that we should revise the insurance limit to a higher amount. So suggestions also say that the amount 1 lakh should be raised to 15 lakh. And if the amount is raised up to 15 lakh, then at least 90% of the accounts will be completely covered. So This is one suggestion. So definitely we can think about reforming the insurance limit, to raise the insurance limit. This is because it was set up in 1993. It's been almost 27 years, 26 to 27 years. So it is high time that we should increase or raise the insurance limit. So this is the first shortfall. Now second one is regarding the coverage. Now suppose if the customers or the depositors of the banks, if they want more coverage than the statutory cover. So statutory cover is 1 lakh rupees. So if the customers want more coverage, then they will have to purchase an additional insurance paying an extra premium. So they have to pay an additional premium in order to get an additional cover for more than the statutory limit. So this is another limitation. So paying an extra premium, then getting extra insurance cover. So this is another shortfall. So what has to be done? The option should be that the extra insurance cover has to be extended directly to banks that wish to increase the coverage of deposits to have insurance coverage more than the statutory requirements. For example, if a particular bank, say for example State Bank of India, if the State Bank of India wants to increase the insurance given to their customers, their depositors, then the entire bank and all the deposits within the bank should have that option, not customer by customer, bank by bank it can be done. So this is the second thing. Now the third limitation is with regard to NBFCs. So when we talk about the role of DICGC, Deposit Insurance and Credit Guarantee Corporation, the coverage of the deposits or the risk coverage for the deposits does not extend to deposits in NBFCs and also cooperative societies. That is primary cooperative societies. So the lack of DICGC's coverage for the coverage for the deposits at the NBFCs and primary cooperative societies is another challenge. So when we talk about the role of NBFCs and also the role of primary cooperative societies in India, they play the role of a shadow bank very well. So they cover the credit needs or credit requirements of the most vulnerable groups at many times. So this scheme should be extended to NBFCs as well as primary cooperative societies as well. Now talking about the next shortfall, another shortfall in the current scheme of DICGC is that rupees 1 lakh insurance would be given, but this 1 lakh would be released only if the bank is bankrupt. So only in case of bankruptcy this amount will be released. So without the liquidation of the bank, no liability accrues on the insurance company to pay such a claim. So only after liquidation this claim will be paid by the DICGC. Now next one, talking about the premium rates. Currently the DICGC charges flat 0.1% insurance premium on the deposits of banks. So this is the premium. So this is flat. That means universally applicable to all the deposits. But an RBI panel has suggested that the premium should be based on differential risk. So in 2015, an RBI panel has already suggested that this amount of or premium or this percentage of premium should be based on the differential risk of the bank. And an SBI report states that 93% of the premium collected by the DICGC in the year 2018-19 came from commercial banks, that is scheduled commercial banks, out of which 75% from the PSBs, public sector banks, and 18% from the private sector banks. According to the same SBI report, 94% of the claims that are settled by the DICGC, it has been from the cooperative banks. It suggests that the risk in the cooperative banks are higher compared to public sector banks and other private sector banks, that is the scheduled commercial banks. So here the difference we will see that 93% of the premium collected is from scheduled commercial banks, whereas 94% of the claims settled are from cooperative banks. So here there is a mismatch. So this has to be properly addressed. So here we will see that this mismatch leads to a cross subsidization. So cross subsidization here means that 93% premium is paid by scheduled commercial banks, whereas the benefit is received by the cooperative banks. So here what happens, the poor governance in the cooperative banks has been cross subsidized by the better performing commercial banks. So it is suggested that the premium should be charged based on the risk aspect. So risk in different types of bank is different. So based on the risk should also be the premium charged. Now next, coming to the private insurers. So another possibility here is to bring the private insurance companies or the private sector insurers and reinsurers into the deposit insurance scheme. So this will definitely drive down the premium prices. And why it is important to cut down the premium prices? According to 2018-19 data, the DICGC collected 12,043 crore rupees as premium. So this much amount they received as premium, whereas they settled only 37 crore worth claims. So a very minimum percentage out of the total premium collected were settled as claims. So the premium amount is definitely high. So if private players come into this, definitely the premium amount will come down. And the private players will also be able to bring in accurate risk-based premium amount or pricing of the policies. So these are the shortfalls, and considering the shortfalls, the government and the RBI should definitely think about bringing structural reforms in the deposit insurance scheme in India. You can find the PDF of this lecture on our website www.studyiq.com. You can follow my Facebook page for more video updates. You can write to me at joycey.studyiq@gmail.com for any of your queries and clarification. Thank you.